Hey guys, welcome back to the channel. Today we're going to talk about one of the new measures that was announced in the federal budget last week, and that is the FHSA, or the tax-free savings account for first-time homebuyers. So I'm going to go through exactly how this was planned out by the government, when it will come into effect, who's eligible for it, and how it's going to work. So stay tuned to the end of the video and I'll give you my thoughts on if I think it's going to be an effective solution to help affordability for Canadians. Before we get there, I would love a like and a subscribe. Very much appreciated if you find any value in this video. And for anybody that's interested in learning more about this, there is a link to my calendar in the description below if you'd like to book a call directly with me. So let's hop into the video. So let's talk about eligibility. Who can actually utilize this program? So you've got to be at least 18 years of age, and this is a first-time homebuyer program, so you can't or you couldn't have owned another property during the preceding 4 calendar years, according to the Government of Canada website. One other important thing is individuals would be limited to making a non-taxable withdrawal for one single property in their entire lifetime. You can't use this for multiple properties, so just make sure that there's some clarity around that, okay? Let me just chime in here. Sorry to interrupt the video, but I just want to remind you that I am not an accountant, and if you have any questions on this from a taxation perspective, please discuss directly with your accountant or with your lawyer. Let's continue. Let's talk about contributions. You have $40,000 of available contribution room in this account, all right? And from a timing perspective, from your first deposit into the account, you've got 15 years to be able to utilize those funds for the purposes of purchasing a home. I'm going to talk to you in a couple minutes about what happens if you decide not to purchase a home with the funds, because that's really important to know. So you've got $40,000 worth of lifetime value of contributions. However, you can only contribute up to a maximum annual amount of $8,000. So if we do some simple math and you max out your contribution every single year, it will take you 5 years to hit that lifetime contribution value, all right? Now, one thing that's really important for you to know on how this differs from a traditional tax-free savings account is it looks really sexy on the surface because you go, cool, a traditional TFSA, I get to contribute $6,000 a year. This, I get $8,000. So I have a little bit more for contribution room for savings. However, with a traditional tax-free savings account, if you don't utilize the entire volume of contribution room, so let's say you have $6,000 available and you only utilize $3,000 this year, your contribution room would, the unutilized contribution room would then roll forward to the next year. So you get another $6,000, you didn't use $3,000 this year, it adds on top, you've got $9,000 next year that you could contribute. This doesn't work that way. If you don't make your full contribution of $8,000 in a calendar year, it resets the next year and you only have $8,000 available. All right, so if you forfeit your contribution room, it's gone for good. Let's talk about withdrawals and transfers, because let's say you save $40,000 in an account and in the future you decide that you don't want to utilize those funds to purchase a property. What happens with these savings? So according to the government website, you have 2 avenues in which you can withdraw these funds. One, you can withdraw it as taxable income, but of course you'd be taxed on it, and that kind of defeats the purpose of a tax-free savings account. 2, you can do a direct transfer to your RRSP, and this is basically a one-time ticket where you can over-contribute without penalties, okay? So you can either withdraw it as taxable income or transfer the funds over to your RRSP and over-contribute that one time. Now, let's think about the flip side. Let's say you've got $32,000 for easy numbers in the FHSA account, and so you go, I wish I could top this up. I just don't have another $8,000 to do so. You are able to top up your account with the funds from your RSP. So you can transfer funds from your RSP to your FHSA to top up the account. But again, you cannot over-contribute. You are still limited to the annual contribution limit of $8,000 a year. And one last thing I wanted to make mention to in that regard is that if you actually make that transfer from your RSP to your FHSA, these transfers would not restore an individual's RSP contribution room. Now I want to talk about how this works in conjunction with the existing savings programs that we've had for Canadians thus far, pre-budget, right? So there's kind of two main savings avenues that first-time homebuyers utilize for the purchases of their first property right now. One being the home buyer's plan. And to give you a little bit of a recap on that, that is being able to withdraw up to $35,000 from your RRSP for the purposes of purchasing a home. If you make a withdrawal of up to $35,000, you do need to repay those funds in 15 years. With this new FHSA program, there are no repayment requirements as of right now. If that changes, I'll let you guys know. The second form of savings would be a traditional tax-free savings account. And I'm not going to go into the details on that because if you want to know more about that, you should watch a whole nother video on how this works. And this probably makes no sense to you anyways. Now, we have home buyer plan, tax-free savings account, and now we have this third one here, which is the tax-free savings account for home buyers, right? This is kind of where the program is a bit shitty, in my opinion. Sorry for the language. But the home buyer plan will continue to be available as under existing rules. However, an individual will not be permitted to make both an FHSA withdrawal and an HPB withdrawal in respect of the same qualifying home purchase. Well, well, well. This doesn't actually help affordability that much then, does it? Because you can pull out $35K from here, you can pull out $40K from here, but you can't pull out $75 because you can't utilize the funds for the same home purchase. And unfortunately, if you read between the lines there, that means you can only use it for one home because both of these programs are only utilized for your first home purchase. So the last sentence is a little convoluted and confusing, but ultimately what that means is you can only utilize up to a maximum of $40,000. And if you want to use the additional $5,000 that this program provides you as an incentive, you need to wait 5 years to do so. So the real question is, do we think that this program is actually going to help the affordability of housing for Canadians, or to make housing more affordable or attainable for Canadians? I don't believe so, because I happen to think that $5,000 in the grand scheme of Canadian housing over the next 5 years is a drop in the bucket. I don't think waiting 5 years to access an additional $5,000 worth of tax-free savings is much of a trade-off at all. That's in my opinion. Okay, now, who does this program actually benefit then? I think there are three segments of the market that may actually benefit from this. The uber wealthy that already have maxed out their RSPs, their TFSAs, and now have an additional vehicle to save for housing. That probably works because it's like a little bit of an overflow account. People with rich parents, and the banks, because now they have an additional product to push, administrative charges, all of that kind of stuff. That is my 2 cents. I'm sorry to be the bearer of bad news. I think this could have been a more effective program. If this program could be used in conjunction with the home buyer's plan, I actually think it's effective. I think there are probably some additional things that I may change. However, I think the lack of integration between programs is essentially nonsensical, and introducing a third program instead of amending the initial program doesn't make a whole heck of a lot of sense to me. So I think there could have been a more effective rollout, but I would love to hear your comments below. Please leave them down there. Curious to see what you guys have to say about this measure or any other measures in the budget, and to get your feedback on that. If you found any value in the video, please give me a like and a subscribe, and I look forward to seeing you guys in the next one.